The Nixon Shock explained how the gold standard ended and changed Forex forever. Before 1971, the world under the gold standard. To understand why the Nixon Shock changed everything, we must first understand how the global monetary system worked before 1971. Number 1. US dollar backed by gold. After World War II, the US dollar was not just paper money. It was legally tied to gold. Under the system established in 1944, the United States promised that 1 ounce of gold equals 35 US dollars. Foreign governments could exchange their US dollars for physical gold held in US reserves. This meant the dollar had intrinsic value. It was not freely printed without consequence. Gold acted as a restraint on monetary expansion. The United States held the majority of the world's gold reserves after World War II, nearly 70% of global supply. This made the dollar the anchor of the global economy. Why this was powerful? Because gold is limited, money supply was limited. Governments could not simply print unlimited currency without risking losing gold reserves. In today's Forex market, currencies float based on policy and speculation. But before 1971, the dollar's value was physically backed by something tangible. That is a completely different monetary world. Number 2. Fixed exchange rates. Under this system, exchange rates were not floating like today. They were fixed. Every major currency was pegged to the US dollar. And the dollar was pegged to gold. For example, British pound had a fixed rate to USD. Japanese yen had a fixed rate to USD. French franc had a fixed rate to USD. This created stability in international trade. Countries agreed to maintain their currency within a narrow band of fluctuation. If their currency moved too far, the central bank would intervene. They would buy or sell USD to stabilize it. This system reduced volatility dramatically compared to today's Forex market. There were 500 pip daily moves. Currencies moved slowly and predictably. But fixed systems require discipline. And discipline is difficult when governments overspend. Number 3. The Bretton Woods system. The entire structure was created at a conference in 1944. Location: Bretton Woods, New Hampshire. Delegates from 44 allied nations met to rebuild the global economy after World War II. The outcome was creation of the International Monetary Fund, IMF. Creation of the World Bank. Establishment of a US dollar-centered global monetary system. This agreement became known as the Bretton Woods system. It made the US dollar the global reserve currency. Meaning, central banks around the world held USD as their primary reserve asset. Instead of holding gold directly, many countries held dollars, because they trusted they could convert them into gold. This positioned the United States as the financial center of the world. Number 4. Why countries trusted the dollar. Trust is everything in currency. After World War II, the US economy was dominant. Europe was rebuilding. Japan was recovering. America held the majority of global gold reserves. The US was politically stable. The dollar represented stability, industrial strength, military power, economic dominance. Countries trusted that the US would honor its gold convertibility promise. And for decades, it did. International trade flourished. Global growth accelerated. The dollar became the foundation of global finance. But there was a hidden weakness. The system required the US to supply dollars to the world for trade. And as more dollars flowed globally, gold reserves began to shrink. This tension is what ultimately triggered the Nixon Shock. By the late 1960s, the United States faced a dangerous reality. Too many dollars. Not enough gold. Foreign nations began questioning whether the US could truly convert every dollar into gold. And when trust begins to weaken in a monetary system, crisis follows. The crisis builds. How the system began to break. By the late 1960s, the Bretton Woods system looked stable on the surface. But underneath, it was cracking. The United States had made a promise. Every $35 equals 1 ounce of gold. The problem? America began printing more dollars than it had gold to back. Number 1. Vietnam War spending and government expansion. During the 1960s, the United States dramatically increased spending. Two major forces drove this. The Vietnam War. President Lyndon B. Johnson's Great Society programs. The government was funding military expansion overseas, social welfare programs at home, infrastructure and domestic reforms. All of this required massive capital. Instead of raising taxes significantly, the US expanded the money supply. More dollars were created. But gold reserves did not increase. This created imbalance. For the first time, the US was exporting more dollars into the global economy than it could realistically redeem in gold. Number 2. Growing trade deficits. After World War II, America dominated global manufacturing. But by the late 1960s, Germany rebuilt. Japan industrialized rapidly. Europe recovered. The US began importing more goods than it exported. This created trade deficits. Foreign countries accumulated large amounts of US dollars. Remember, every dollar they held could technically be exchanged for gold. The more dollars that left America, the greater the gold redemption risk. Foreign central banks started asking a serious question. Does the United States actually have enough gold to back all these dollars? That doubt was dangerous. Number 3. Gold reserve drain. By the late 1960s, some countries began testing America's promise. France, under President Charles de Gaulle, was especially skeptical. France began exchanging dollars for gold. Other countries followed. Gold started leaving US vaults. At its peak, the US held over 20,000 tons of gold. By 1971, that number had fallen dramatically. The math was becoming obvious. There were more dollars in circulation globally than gold available to redeem them. If every country demanded gold at once, the system would collapse instantly. The world was approaching a bank run, but at a national level. Number 4. Breaking point, August 15, 1971. On Sunday evening, August 15, 1971, President Richard Nixon addressed the nation on television. He announced what he called a temporary suspension of the dollar's convertibility into gold. Temporary. But it was not temporary. This decision became known as the Nixon Shock. With one announcement. The gold standard effectively ended. The Bretton Woods system collapsed. The dollar was no longer backed by gold. Currencies would eventually begin floating freely. The modern Forex market was born. Number 5. Immediate market reaction. At first, markets were confused. Governments attempted to salvage fixed exchange rates temporarily. But by 1973, the system officially transitioned to floating exchange rates. For the first time, currency prices were determined by supply and demand, economic performance, interest rates, and market speculation. Volatility increased. Opportunity increased. Risk increased. Forex trading, as we know it today, became possible. Why this changed Forex forever? Before 1971, currencies were politically controlled and stable. After 1971, currencies became economic instruments influenced by central banks, inflation, monetary policy, geopolitics, speculation. This shift created the modern interbank FX market, the rise of currency speculation, the power of central banks, the dominance of interest rate policy. Without the Nixon shock, there would be no floating euro to US dollar, no DXY index, no leveraged Forex trading, no modern currency volatility cycles. Everything you trade today exists because of that decision. Powerful closing statement for video. The Nixon shock was not just a policy change. It was the moment money became political. And from that day forward, currency value would depend not on gold, but on trust, policy, and economic strength. And in Forex, trust moves price. The Nixon shock still impacts Forex in 2026. The gold standard ended in 1971. But its consequences are still shaping every trade you place today. Number 1. Floating exchange rates equals volatility and opportunity. Before 1971, currencies were fixed. After 1973, currencies floated freely. Today, euro to US dollar, pound sterling to US dollar to Japanese yen move based on interest rate expectations, inflation data, central bank speeches, geopolitical risk, market speculation. If currencies were still fixed to gold, modern Forex trading would barely exist. The entire leveraged retail FX industry exists because Nixon closed the gold window. Number 2. Central banks became more powerful than gold. Gold used to control money supply. Now central banks do. Today, the Federal Reserve influences USD through interest rates, quantitative easing, balance sheet expansion, forward guidance. Money is no longer limited by physical gold. It is limited by confidence. This is why inflation cycles happen. Currency devaluations occur. Emerging markets collapse. Safe haven flows exist. The Nixon shock created the era of policy-driven currency value. Number 3. Inflation became a structural risk. Under the gold standard, excess money printing meant gold would leave reserves. Today, money can expand without gold restraint. This led to 1970s stagflation, repeated inflation cycles, modern debt expansion. Currencies now weaken when money supply expands too aggressively. This is why traders monitor CPI, PCE, money supply data. The Nixon shock made inflation a permanent macro risk factor. Number 4. The rise of the dollar index, DXY. The dollar index was created in 1973, after Bretton Woods collapsed. Why? Because currencies were now floating. Traders needed a way to measure USD strength. DXY became the heartbeat of global currency positioning. Without floating rates, there would be no DXY. And today, DXY influences gold, oil, emerging markets, crypto, stocks. All roads lead back to 1971. Number 5. Modern debt and currency cycles. Once gold discipline disappeared, governments borrowed more aggressively. Debt cycles intensified. Currency cycles became linked to monetary expansion, fiscal stimulus, global liquidity waves. Every time central banks inject liquidity, we see a risk on rallies, dollar weakness, asset inflation. Every tightening cycle brings a dollar strength, a risk off, a emerging market stress. These cycles exist because currencies float. And they float because Nixon ended gold convertibility. Powerful closing line. The Nixon shock was not just the end of gold backing. It was the birth of modern monetary power. And in today's Forex market, policy is gold. If this breakdown helped you understand how the modern Forex market was born, then click on the subscribe, like, and share button and you will get notified as we create more deep market history and real macro intelligence. And in the comments, I'd like to ask you, do you think the gold standard should ever return, or is floating currency here to stay? I read every comment.